So Roper Technologies, Q2 2026. A definitive beat on both the top and bottom lines for consensus. Let's just get right into those headline numbers for you. Revenue increased 9% year over year to $2.11 billion.
Right, which is huge.
Yeah, it breaks down to 5% organic growth and a 3% contribution from M&A. On the bottom line, adjusted diluted earnings per share is up 10% to $5.38. And if you're looking at the GAAP numbers, diluted EPS jumped a massive 233% to $11.62.
I mean, the gap jump is just crazy. But we'll get into that.
We will. And management is carrying that momentum forward, aggressively raising their full year 2026 guidance. They now expect total revenue growth of 8% or more, and they bumped their adjusted DEPS target to a new range of $22.15 to $22.30. And the stock reacted exactly how you'd expect, right? It popped about 3% in early trading right after the report dropped.
Yeah, it's a fundamentally strong print across the board. The market is digesting a report that basically says, the underlying engines of this business are firing on all cylinders.
Absolutely.
They established Q3 guidance at $5.75 to $5.80 for adjusted DEPS, and they even ticked up their full-year organic growth outlook from that 5% to 6% range up to a very solid 6%.
Which sets the exact mission for our deep dive today. We are pulling directly from Roper's Q2 2026 earnings call, their press releases, and that big investor presentation to really unpack these numbers for you.
Yeah, a look under the hood.
Exactly. Our goal is to get past the headlines. We're going to look at the mechanics of Roper's massive cash generation, analyze the segment-level performance, including what looks like a very aggressive push into AI, and finally, weigh management's optimistic outlook against the macro risks they're flagging in the fine print.
Because to really understand how Roper is in a position to confidently raise full-year guidance in, like this kind of macroeconomic environment, you have to start with the balance sheet and their cash generation.
Right.
That is the fuel for their entire capital deployment strategy. I mean, without understanding the cash, the rest of the earnings report is just noise for you.
Right, because Roper essentially operates as a massive cash machine. Let's look at the quarterly numbers to see what that actually means. Adjusted free cash flow grew 11% to $447 million just in Q2.
Yeah.
Which is a great quarter, but the number that really jumps off the page for you as an investor is their trailing 12-month free cash flow. It currently sits at an incredibly impressive $2.565 billion.
And, context is everything for that specific figure. If you look at a 3-year compound annual growth rate, that trailing 12-month free cash flow has grown at 18%.
Wow.
Generating over $2.5 billion in free cash flow annually just gives the management team incredible optionality. They maintain over $5 billion in annual capacity for capital deployment.
That scale is just wild.
Just think about it. And they exited this second quarter with a net debt to EBITDA ratio of 3.4x.
Let's actually pause there for a second. We throw around EBITDA margins and ratios a lot on this show, but for you listening, that 3.4x net debt to EBITDA ratio basically means if Roper used every single dollar of their core operating earnings, it would take them just under 3.5 years to pay off all their debt.
Yeah, exactly.
And they have the liquidity to manage it, right? I mean, they are backed by $365 million in cash, and they have $2.9 billion drawn on a $3.5 billion revolving credit facility.
Right. It is a very manageable leverage profile for a company with this kind of, recurring revenue.
Yeah.
And they are also bringing even more cash in the door from divestitures.
Oh, right. The Emitech deal?
Yeah. They announced that Indicor, which Roper holds a minority stake in, reached an agreement to sell its instrumentation businesses to Emitech. And that deal is expected to generate $1.4 billion in gross proceeds.
So the war chest is completely full. But here's where we have to look really closely at what they're actually doing with that cash right now, because the strategy is fascinating.
It really is.
In Q2 alone, they repurchased 3.6 million shares for $1.2 billion. If you look at the program to date, over the last 3 quarters, they've bought back 9 million shares for $3.2 billion.
Which represents more than 8% of their total outstanding shares. They have managed to roll their diluted share count all the way back down to 100.6 million shares.
I look at that scale of share repurchasing, and it is basically financial time travel. They've aggressively erased over a decade of share dilution, taking their total share count back to 2013 levels.
Yeah, it's wild.
But wait, I have to call a timeout and push back on the narrative here. Management explicitly stated in their presentation that they expect an attractive M&A environment.
Right.
Yet, if you have $5 billion in deployment capacity and you are out there buying back 8% of your own stock, isn't that a glaring signal that external M&A targets are currently just too expensive? Like, why on earth would a serial acquirer buy their own stock if there are so many attractive targets out there?
It is the most critical question to ask when you look at this print. When you see a historically aggressive serial acquirer like Roper pivoting this hard into share repurchases, it tells you a lot about their internal hurdle rates.
Hurdle rates being like the minimum return they demand before they pull the trigger on an investment, right?
Exactly. They have a highly disciplined, analytical, process-driven approach to capital allocation. Right now, buying back their own stock at current valuations offers them a guaranteed, completely risk-free return on that capital.
Interesting.
Yeah, it effectively compounds their free cash flow per share for the remaining investors. It's not necessarily that all M&A targets are universally too expensive across the board.
Okay.
It's rather that the relative risk-adjusted return of buying their own proven, highly profitable cash streams currently outweighs paying a premium to buy and integrate a brand new business.
So it's a bird in the hand versus two in the bush.
Precisely. They know their own businesses inside and out. There's zero integration risk when you buy your own stock.
Right.
They are essentially keeping their powder dry for future acquisitions while still delivering massive immediate shareholder value through those buybacks.
Which brings us perfectly to where those proven, highly profitable cash streams are actually originating. We've seen exactly what they're doing with the cash, but let's look under the hood at the three core segments generating it.
Let's do it.
If you step back and look at the business model, Roper essentially operates like a highly curated app store for niche B2B industries. I mean, they own these hyper-specific vertical software companies for everything from running a law firm to managing freight trucks on the highway.
That is a great way to visualize it. And the undisputed heavyweight in that portfolio is their application software segment. In Q2, this segment alone delivered $1.181 billion in revenue.
Just huge.
Yeah, that is an 8% total increase year over year, with 5% of that being organic growth. But what you really need to pay attention to is the profitability. They posted a staggering 42.8% adjusted EBITDA margin.
A 42.8% margin is phenomenal. Management highlighted a really great quarter from Aderant, which provides software specifically for the legal sector.
Right.
They also noted continued strength in Deltek's private sector business, along with a very stable government contracting market. But what really stands out when you read through the segment highlights is the massive, aggressive push into artificial intelligence.
Oh yeah, it's everywhere in the report.
Aderant launched their first-generation AI agents for things like collections, billing appeals, and talent management. ProCare, which is their child care management software, launched an AI agent specifically designed for enrollment forecasting. Vertafore launched 6 different agents on their AI platform.
And you see a very similar playbook being executed in their second division, the network software segment. This segment brought in $431 million in revenue for the quarter.
Okay.
That's a 12% total increase broken down into 4% organic growth and a massive 8% contribution from M&A. And the margin here is actually the highest in the entire Roper portfolio, coming in at an eye-watering 50.9%.
A 50.9% margin on hundreds of millions in revenue is just incredible pricing power. In that segment, they noted that D-Date, which operates as a digital freight marketplace, is showing solid growth.
Yeah.
And early signs that the broader freight market is actually improving after a rough cycle. And again, just like in application software, the AI rollout is front and center here.
Always.
Foundry and Subsplash are rolling out new AI capabilities for data and people insights, and Construct Connect is seeing continued adoption of their AI takeoff solution for construction estimation.
Finally, to round out the portfolio, we have the Technology-Enabled Product segment, often referred to as TIPA. This segment generated $497 million in revenue.
Got it.
And this was purely organic growth, up 7% year over year. The margin sits at 34.5%. NDI saw continued momentum for their precision measurement solutions, and Verathon grew based on their single-use medical offering.
Oh, like the B-Flex stuff.
Exactly, highlighting products like the B-Flex and GlideScope. They did note that Neptune declined, but the decline was less than they originally expected, and they're seeing continued steady adoption of cloud-based software solutions within that business.
So when you blend all three of those distinct segments together, Roper's overall adjusted EBITDA margin sits at a very healthy 38.6%. But I want to circle back to this AI narrative because, honestly, I am skeptical.
Fair.
Let's be real for a second. Every single management team across the entire stock market right now is slapping the letters A and I onto their earnings transcripts to get a bump in their stock price.
Yep, buzzword bingo.
Exactly. Roper's heavily touting these commercial agentic releases across the entire portfolio. But I have to ask you, are these AI features actually driving that 5% organic revenue growth today? Or is this just buzzword bingo designed to keep their software multiple high for Wall Street?
It is the defining question for enterprise software right now, and it is perfectly valid to be skeptical. When you look at Roper's specific applications, think about forecasting enrollment for a local daycare, or automating complex billing appeals for a massive law firm,
Right.
or analyzing freight capacity for long-haul truckers. These are deeply entrenched, mission-critical workflow solutions.
True.
So to answer your question directly,
Yep.
no, the AI is not the primary driver of today's revenue. The 5% organic growth you are seeing right now is largely driven by their traditional recurring and reoccurring revenue models, standard annual price increases, and continued migration to the cloud.
So the AI agents are just a bonus feature right now.
Currently, yeah. They function much more as retention tools and upsell features rather than the core engine of the immediate top-line revenue beat. However, you have to look at the long game.
Okay, lay it out for me.
By embedding artificial intelligence deeply into these hyper-specific vertical workflows, they are fundamentally increasing the stickiness of the software. It defends the economic moat.
Ah, I see.
So while it might feel like buzzword bingo to a casual observer scanning the transcript, for the actual end user operating in a niche industry, an AI agent that accurately automates a painful, hours-long administrative task is incredibly valuable.
Which justifies the price hikes.
Right. That value supports Roper's pricing power long-term, allowing them to maintain those 40% and 50% margins year after year.
That pricing power and margin stability is exactly what translates into management's confidence to raise the forward guidance. But as retail investors, we cannot just take the headline adjusted numbers at face value and call it a day.
No, definitely not.
We need to look closely at the reconciliation between GAAP and non-GAAP earnings, and then we need to weigh the specific macroeconomic risks management is flagging for the rest of the year.
Yeah, this quarter actually provides a perfect textbook case study in why that GAAP to non-GAAP reconciliation is so incredibly critical for you to understand.
Because of that massive jump.
Exactly. The headline number we discussed at the top of the show was $5.38 in adjusted diluted earnings per share, but the GAAP diluted EPS was $11.62. It is exceptionally rare to see GAAP earnings more than double the adjusted non-GAAP metric.
Right. Usually it's the exact opposite. Companies usually strip out a bunch of ugly operational expenses to make their adjusted earnings look much better than the reality.
Exactly.
I always compare non-GAAP adjustments to looking at a house with adjusted curb appeal. Like, you are standing outside admiring the fresh landscaping and the beautiful new paint job, but you are actively ignoring the reality of the massive, expensive mortgage you have to pay every single month to live there.
That is a brilliant analogy. And in Roper's specific case, that mortgage you were talking about is the amortization of acquisition-related intangible assets.
Okay, let's unpack that jargon for the listener. What exactly is an acquisition-related intangible asset, and why does it impact the earnings so heavily?
Well, because Roper is a serial acquirer, they don't just buy factories or inventory. They buy software companies. So they carry a huge amount of intangible assets on their balance sheet.
Like what?
Things like proprietary software code, customer lists, and brand value from past acquisitions. Accounting rules, which dictate GAAP, require them to slowly expense the value of those intangible assets over time. That process is called amortization.
Okay.
In Q2, Roper added back $164 million after tax, or 1.63 per share, to their adjusted DEPS to account for this amortization.
So it is essentially a phantom accounting expense that lowers their official GAAP profit, but no actual cash is leaving Roper's bank account today to pay for it.
Exactly. It's a non-cash expense today, but it is a very real reflection of the premium they paid for past acquisitions years ago.
Right.
Management strips it out of the adjusted number so investors can see what the actual day-to-day cash-generating power of the business looks like without historical accounting noise.
But wait, if they stripped out a $1.63 expense, that would mean the GAAP number should be lower than the adjusted number. But the reason the GAAP number was so incredibly high this quarter, jumping to $11.62, wasn't because of an operational expense at all.
No.
It was driven by a massive one-time financial gain.
You hit the nail on the head. The main bridge between the $11.62 cap and the $5.38 adjusted EPS is primarily driven by the financial impacts associated with their minority investment in Indicor.
Ah, the divestiture.
Right. Because of the divestiture agreement we mentioned earlier, Roper recorded a pre-tax gain of $835 million on their books. When you factor in taxes, that translates to a $791 million after-tax gain, which is a massive $7.86 per share impact.
That is a staggering number for a single quarter.
It is. But management rightfully strips this out of the adjusted numbers because it does not reflect the core, ongoing operating performance of their software and technology businesses.
Right.
It is a mark-to-market financial impact. If you left that $7.86 in there, it would make Roper's core software business look wildly more profitable this quarter than it actually is.
And it would set an impossible comparative bar for next year.
Exactly.
Stripping it out is definitely the right move for evaluating the true health of the operating business, but we also need to objectively evaluate the risks to that operating business. In their safe harbor statement, management flagged a very specific set of challenges that you need to be aware of.
Yeah, they didn't hold back.
They highlighted the execution risk of integrating newly completed acquisitions, the actual technical ability to successfully deploy artificial intelligence at scale, ongoing labor shortages in their specific industries, and potential write-offs of those substantial intangible assets we just talked about.
They also explicitly called out volatile interest rates as a material risk factor.
And that is exactly where I want to push back on the bull thesis. Roper exited the quarter with a 3.4x net debt to EBITDA ratio, which you said was manageable.
Yep.
But they have $10.6 billion in total long-term debt sitting on the balance sheet. Their entire growth model relies heavily on utilizing that $5 billion in capital deployment capacity to go out and buy more companies.
Right.
So if we see a macroeconomic scenario where volatile interest rates spike again and stay higher for much longer, how vulnerable is that 3.4x leverage ratio?
Right.
Like, does a significantly higher cost of debt essentially break their acquisition-driven compounding machine?
Well, it doesn't break the machine, but it absolutely changes the math. And it is the right risk to focus on. A 3.4x leverage ratio is not insignificant when you are carrying $10.6 billion in debt, especially in a higher rate environment.
Definitely.
To put real numbers to it, their interest expense for the first 6 months of 2026 was $210.7 million. That is up significantly from $142 million in the exact same period last year.
Wow.
Yeah, that is a real, tangible cash cost eating into their bottom line.
So the debt is getting noticeably more expensive to carry.
It is. However, the ultimate mitigant here is that incredible cash generation we discussed in the very beginning. Generating over $2.5 billion in free cash flow annually allows them to service that rising interest expense very comfortably.
Right.
And it allows them to de-lever the balance sheet rapidly if they choose to completely pause M&A. The risk for you as an investor isn't necessarily insolvency or bankruptcy.
Okay, then what is it?
The risk is that higher borrowing costs lower the internal rate of return on their future acquisitions.
Make that make sense for the listener. How does the interest rate directly impact the acquisition strategy?
Well, if the debt they need to use to buy a company is suddenly much more expensive, they have to demand lower purchase prices from their acquisition targets to make the math work and hit their required return.
Oh, I see.
Right? And if private software founders refuse to lower their asking prices, it could dramatically slow down the pace of Roper's inorganic growth.
Right.
That dynamic is likely another major reason why aggressively buying back 8% of their own stock was the most attractive, lowest risk use of capital this year.
That makes perfect sense. They are optimizing for the absolute best return on capital in the current interest rate environment, which right now means betting heavily on themselves instead of overpaying for a private target.
It is a masterclass in capital allocation discipline.
Yeah.
You're watching a management team generating massive amounts of cash from highly defensive niche software verticals.
Yeah.
They're utilizing that cash to erase a decade of stock dilution when external targets are too pricey, and strategically planting AI flags across their portfolio to protect their future pricing power.
And that leaves us with a final, somewhat provocative thought for you to ponder as you digest this earnings report. We spend a lot of time discussing how Roper is successfully deploying these AI agents to handle billing, enrollment forecasting, and talent management within these hyper-specific niche industries.
We did.
Now, the ultimate endgame for vertical software has always been about entirely owning the specific workflow of a specific industry. But as these AI agents become more autonomous, more capable, and frankly more generalized, we have to ask a difficult question.
Here comes.
Will AI eventually commoditize these incredibly niche software products?
That is the existential question.
Right, because if an off-the-shelf generalized AI model from a major tech giant can eventually learn to independently navigate the complexities of government contracting or map out freight logistics just by reading documents, does Roper's hyper-specialized software lose its immense value?
It's a huge risk.
Or, on the flip side, does owning the proprietary industry-specific data, like the literal decades of highly specialized private information flowing through platforms like Aderant or BE, give Roper an impenetrable moat that a generalized AI model can never cross? It is the multi-billion-dollar question for the future of B2B software.
The data is the moat. But exactly how deep that moat truly is against the next generation of artificial intelligence will ultimately determine the future valuation multiple of this entire sector.
Make sure to follow the show for your daily earnings coverage. We will be right back here tomorrow unpacking the next print.